Welcome to our Taking Stock episode for the week ending the 26th of June 2026. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome back, Matt.
Oh, thank you so much for having me, Kien. And this is the last episode for the financial year, so we'll get into some conversations around some tax loss selling strategies.
Yeah, definitely. How time has flown. But before we begin, just a reminder that today's discussion is general in nature and won't consider your personal situation. Remember, shares are volatile, so any information that is here today, you should consider whether it's appropriate for you as an investment. But Matt, investors had plenty to digest this week. You had underlying inflation. It surprised on the upside. The labour market also remained quite tight, and confession season that continues to play out with a few downgrades this week.
Yeah, that's right, Kien. And while headline inflation eased to 4% because of the temporary fuel excise cut, the RBA's preferred measure of underlying inflation rose from 3.4% to 3.6%. And if you add to that stronger than expected jobs reports, and markets are increasingly expecting interest rates to remain higher for longer.
Yeah, and you can see that with the chart on screen, which shows how interest rate expectations have moved. That dark blue line is where we are today. And as you can see, interest rates are not expected to be cut until at least 2027.
And this thematic does tend to weigh on growth stocks, which do have a longer duration cash flow profile. But interestingly, we're beginning to see buyers selectively returning to oversold growth names like CSL, Technology One, and Pro Medicus.
Yeah, but as we discussed previously as well, it is quite a very selective market at the moment, especially during confession season, with stocks like Worley's and Baby Bunting, and even in the financial space, Judo Capital, they had to downgrade their earnings this week as well. And speaking about volatile stocks, let's turn to former Star Growth stock, WiseTech Global, a global logistics software provider. Now, early in the week, there were reports emerging that the Australian Federal Police were investigating founder Richard White over allegations he exploited a woman's immigration status and financial circumstances in exchange for an intimate relationship. White has denied those allegations, so no charges have been laid just yet.
Yeah, Richard in the headlines once again for all the wrong reasons. And this is coming on the back of significant cost cuts and management having reaffirmed their full year guidance. And that takes into account the integration of its major E2 Open acquisition, which they say is progressing as planned. But the issue is obviously, again, around governance uncertainty. Richard remains central to the company's strategy and product development. So multiple investigations do create this level of uncertainty that many institutional investors simply aren't comfortable with. This explains why there is fairly high short interest at 8%.
Yeah, quite a number of large risks here at the moment, and that's exactly why we've remained on the sidelines. You've got governance. That's only one part of the story. The company is also integrating its largest acquisition while trying to adapt to a rapidly evolving AI landscape, and those execution risks have increased considerably. While at the same time, the company needs to meet their ambitious earnings targets when they report next in August. But staying with technology now and moving into healthcare, medical imaging software business Pro Medicus, they continue to demonstrate how they're taking advantage of this AI disruption thematic. And this week, the company announced a strategic partnership with Echo IQ, which develop AI software designed to help doctors identify serious heart disease using ultrasound scans.
Yeah, another encouraging development. And Pro Medicus isn't trying to compete with every AI company. Instead, it's using its Visage platform as the distribution channel. Hospitals are obviously already using Visage and can potentially access these specialized diagnostic tools through software they're already familiar with. And that creates another revenue opportunity without requiring Pro Medicus to build every AI application itself.
Yeah, quite strategic there, but some investors still worry whether AI will eventually replace medical imaging software altogether. And we think this is unlikely. You've got hospitals, they require extremely accurate, reliable systems because they're making decisions about patient care. And AI can certainly improve productivity, but it still needs to operate within that trusted clinical software and highly regulated framework.
That it does, Keen, and that's why we believe the recent AI fears have been well and truly overdone. It's very pleasing to see Pro Medicus well off their lows, and more pleasingly, they were seeing positive earnings revisions come through over the last 3 months.
Now for Under the Microscope this week, let's look at Jumbo Interactive, the online lottery company behind Oz Lotteries and also several lottery software platforms used by governments, charities, and international lottery operators. And the share price fell sharply on Thursday after a major broker downgraded the stock. Matt, what were the reasons for the downgrade?
Well, there were several factors cited. Lottery sales have weakened because there have been fewer major Powerball and Oz Lotto jackpots, with ticket volumes tracking around 18% below the same period from last year. The broker also pointed to regulatory uncertainty in the UK, where a 20% tax on prize draws could pressure margins, along with concerns about Jumbo's long-term reseller agreement with the Lottery Corporation, even though the contract doesn't expire until 2030.
Yeah, quite interesting, Matt. I mean, it appears that the broker was simply also aligning their target price more closely with market reality. But investors are also questioning whether Jumbo can continue charging up to 10% premium as AI lowers barriers to developing digital lottery platforms. And the Lottery Corp, they could strengthen their own online offering as well here.
And that's probably the real market concern, Ken. Jumbo still operates a quality founder-led business with strong cash flow generation, but investors are questioning how much market share it can realistically win from here and grow its earnings base. Earnings remain heavily influenced by jackpot activity, which is something management simply can't control.
And despite these concerns, Matt, the valuation remains quite attractive. The stock now trades on a PE multiple of about 8 times and sits well below analyst price targets. But a low valuation alone isn't enough to trigger a re-rating if earnings expectations continue to fall.
Yeah, very true. So we'd prefer to see domestic lottery sales stabilise and greater clarity around those contract and regulatory issues before becoming more constructive.
Mm.
Investors should also think about the opportunity costs. Other high-quality technology businesses such as NetWealth and Technology One have also been sold down this year, but don't face the same level of business uncertainty.
Yeah, but one question we're also receiving relates to its dividend. Now, the current gross dividend yield is around 6%. Is this sustainable, especially if those growth numbers come through as well?
Yeah, I think at this stage I'd say yes. Free cash flow comfortably supports the dividend, and management has adopted a more conservative payout policy following its recent acquisitions. Longer term, further acquisitions are on the table, and these could help the business diversify earnings beyond Australian lottery sales, reducing dependence on jackpot activity.
With the end of the financial year approaching, a timely question for many investors is how can Stock Doctor help investors prepare for tax time?
Great question, Kien. And the first step is making sure your Stock Doctor portfolio accurately reflects your brokerage account. Review your holdings, recent transactions, and dividend payments within Portfolio Director so your records are complete.
And once that's done, though, head to the reports section. There you'll find summaries of dividend income together with realized capital gains and losses. Each income item is linked to the relevant tax return label, making tax preparation quite simple.
And if you've realized significant gains this year, lucky you, but you may also wish to consider some tax loss selling. Selling financially weaker investments can offset capital gains, but remember the ATO's wash sale rules generally prevent immediately buying back the same stock.
Yeah, instead, you could also prefer switching into stronger companies within the same industry. And that's another area where Stock Doctor can help identify businesses with better financial quality and stronger long-term outlooks.
And finally, when it's time to meet your accountant, simply export your reports as either a PDF or a CSV version. The platform also allows you to include cash, term deposits, and other investment assets, giving you a complete picture of your entire portfolio.
Yeah, thanks, Matt. And that brings us to the end of this week's episode of Taking Stock.
Thanks, Ken.
Happy end of financial year to everyone. And it's been a challenge, especially for growth stocks, but hopefully things will recover next year. Until next time, have a happy, healthy, and prosperous week ahead.